Conclusion. A quick recap of all that we covered in this session. We first discussed what is a partnership, why a partnership is formed. A partnership is formed in order to pool money, pool financial resources, pool other resources, non-financial resources, coming together of more money as well as more expertise, more experience, more technical knowledge. Along with partnership, we also discussed a special kind of partnership, the limited liability partnership, which combines the advantages of a partnership and a company form of organization. This is a structure, is totally in the form of a partnership, but the partners have limited liability. What was a partnership? How did we define a partnership? Partnership is a relationship between persons who want to carry on, who want to share the profits of a business which is carried on by all of them or any one of them acting for all. So there is a relationship of agency between all the partners, because a partner represents the partnership firm and a partner also represents all other partners in its partnership dealings. And a limited liability, but partners have unlimited liability. A limited liability partnership is a special kind of business structure wherein it is a partnership business form of organization. However, the partners have limited liability. What is a partnership agreement? A partnership is based on an agreement. The partners agree on how the profits to be shared, agree on the business to be done, agree on division of duties, agree on whether interest has to be paid on capital, interest on loan, whether interest needs to be charged on drawings, whether salaries should be paid to a particular partner, any commission is payable, etc., etc., etc. So it is always best that a partnership agreement is there in writing and it is also registered so that it can be admitted in a court of law if required. Then we discussed final accounts of partnership. Actually, what we said was that the final accounts of a partnership, like in case of a sole proprietorship, consists of a trading account, a profit and loss account, but the extra thing here is the profit and loss appropriation account, which deals with the distribution of profits to partners. The profits may be distributed in the form of interest on capital, in the form of salary if any, and the profits are distributed, remaining profits are distributed in the profit sharing ratio. We had also said that in the absence of an agreement, the provisions of the Partnership Act apply, and the provisions, what are the relevant provisions of the Partnership Act? With respect to distribution of profits, we said no interest on capital is payable to the partners, no interest on drawings is charged, no salary is to be paid to the partners. If a partner has, however, advanced any loan to the partnership, a 6% interest on such loan should be given. Profit sharing ratio, if it has not been agreed upon, should be equal. And if it is agreed to give interest on capital or salary to partners, these should come out of profits. These should come out of profits. Then we discussed interest on capital and we did interest on drawings. If the drawings are regular, a fixed amount at every month, if it's a fixed amount at every month, we said interest on drawings could be computed more easily. We could just use a single formula depending on whether the drawings were made at the beginning of each month, middle of each month, or end of each month. If the drawings are made at the beginning of each month, interest is computed on the total amount for 6.5 months. If it is made at in the middle of each month, then we compute the interest, apply the rate of interest on the total amount of drawings and calculated for 6 months. If it is at the end of each month, then total amount into rate of interest into 5.5 months. We also saw that interest on drawings could be computed either under the product method or under the simple method, the total method, where each computation is taken. The product method was a little faster. Next, what we discussed was change in profit sharing ratio. When can this reconstitution happen? When the partners agree among themselves to have a change in their profit sharing ratio. When a new partner is admitted into the business. When a partner retires, or on the death of a partnership, there could be change in the profit sharing ratio. Next, we discussed goodwill. We understood what is goodwill, how it is valued. We said there were 4 methods of valuing goodwill: the average profits method, super profits method, capitalization method, and the annuity method. And we also discussed accounting entries. The basic principle is that the sacrificing partner's capital account is credited and the gaining partner's capital accounts are debited. So we discussed accounting entries when profit sharing ratio changes, when on the admission of a partner, on the retirement or death of a partner. With that, we conclude this first module, one part of the partnership accounts. Thank you.